Hi, everybody. Look, I'm lucky enough to have Andrew Tauriello from Little Bull Finance. Andrew, thanks for joining me.
No, thanks for having me.
Well, look, the big news over the last few weeks has been around tax reform and budget changes, and ultimately negative gearing is being stripped away from new purchases,
hmm
but those existing investors can still retain it. How has that affected investors and rent investors? Predominantly, we've noticed from borrowing calculators and borrowing capacities.
Yeah, I think there's a lot of inconsistency at the moment. It's still early days. We're still waiting for this to be passed as well. So until then, we've got a lot of, I wouldn't say miscommunication, but some banks are here, some banks are here, and this range of borrowing calculations is huge.
Hmm.
And it doesn't help when we're talking to clients because they don't fully understand. And even from my end, we expect lenders to be on top of this kind of stuff. But some of them will make the decision, and early on, some of them made the decision to fully take off, I wouldn't say negative gearing, but take off the interest deductibility in the lending calculators. And that's not right
Hmm.
because they were making a rash decision, maybe to be compliant or to be on the safe side. Number one, these rules haven't passed yet, technically. Yes, they probably will go ahead, but still, these are early day decisions, only a few days out. Number two, you can't just take away the whole interest deduction when you're doing a calculation. It's more complicated than that because that will assume that basically we can't deduct any of the interest or any of the outgoings on a property. When in fact, from the information that we know, you just can't go past zero. You
Hmm.
can't offset
Yeah.
the loss against your standard PAYG or taxable income, and that's a big difference.
Hmm.
So what I'm finding now is that probably half the banks are playing ball, half of them aren't. Some of them have done the calculations now finally correctly,
Hmm.
but some of them still lag behind. And there's a few that haven't made the decision. And they'll only be moving when it's actually passed through the Senate. So rent investors are, to be honest, they're confused. And even from our end, experienced brokers, we have to be quite vague with the clients. We have to tell them, hey, this is what it is today.
Hmm.
But if you're not going forward with a signed contract and we're applying for a formal approval right now, this could change.
Yeah.
Banks are giving people pre-approvals, then taking them back.
Hmm.
Okay, and saying, sorry, if it wasn't fully signed, if it wasn't gone ahead, if you have an exchange and we haven't given you a formal loan offer, then we're retracting our pre-approval. So they're hesitant, understandably so. Borrowing capacities have dropped for most people that are trying to buy an existing property. Rent investors who are just trying to get ahead, they can't afford to buy where they want here. So, hey, I'll get started with something. They're being penalized. And we see that's probably, look, it depends on the situation, but probably say around 15% borrowing power. That's the reduction that we see if we use the right calculations, or what it will be in, say, 2 weeks' time once everything is finalized. There could be some instances where it's higher, especially if you're buying a property that's maybe a higher price point with a lower yield, right? So if you're buying a $2 million property
Hmm.
and it's only getting you, $800 a week, we're in trouble. It's going to
Yeah.
be a lot more than that. But for people on the lower end of the price point, maybe 500 to 700K, an average of 15%, give or take 5 each way. So that's what we're seeing at the moment. They're hesitant. They are holding back. They're still looking. If their borrowing capacity is high enough, they are looking to go ahead, but they're just cautious. And they really want to understand the implications of, well, if I can't negatively gear this, what can I do?
Yeah.
And my job, I guess, is just to educate them on what they can do now and let them know that these decisions, number one, haven't been formalized, but number two, these can change
Yeah.
anytime. We've got negative gearing up till 1st of July 2027, potential election the May after. Someone else could come in and
Yeah.
wind it back, and there's actually no change.
Yeah. Yeah. And
So it's a funny time.
just a short-term interruption, and I'm finding
Mm.
people are a lot more cash flow conscious. But what is the behavior that, because people naturally will see you, they'll go to see your mortgage broker before they come see me, because
Yeah.
they want to understand what to invest. What's their behavior like? Are they more cash flow conscious as a result?
I think it's especially the first time investors or second time investors. Yes,
Hmm.
they are, because they're usually buying an investment property because they can't get what they want here, or they don't think it's viable. So they don't want to be forking out too much money every week or every month. A little bit they can handle, and if there was a few $1,000s, a year, or 5 or 10 grand that they can't deduct the loss off their income, then they're still okay with it. But they don't want to be going for a property with 2 or 3% yield. They want 4% plus. They want to be able to make sure that, hey, this is not going to impact my lifestyle
Hmm.
too much. Of course, there is a bit of a trade-off. just not to the extreme. The more sophisticated investors that I'm seeing, they're still cash flow conscious, right? They're very good with their numbers, but I guess they've got a bit more wiggle room as to what they can do. They've got other, they might have properties that are positively geared that, once we do the calculation, they can offset some of the loss of other positively geared rent, rent that they get, and it's not too bad. Or they're actually quite advanced and they're like, hey, I've been here before, I've seen these changes. I'm confident in 2 or 3 years, this is not going to be the case. So if I can buy at a discount now, if I can get 5% or 10% off a purchase price in the next 6 months, and maybe for the first year or two, I can't, save 5 or 10 grand in tax. They say, well, who cares? I'm saving 50 grand or 100 grand up front. I'm fine for 10 years. So that's the difference. And I guess it's educating people as well from my end. Hey, this is what is happening now. It could all change. Don't base a 20 or 30 year decision off the last 3 or 4 weeks. There's too much for that. And history's shown us that things chop and change. And to be fair, wherever there's money to be made, rules are going to change.
Yeah. I think it's important to understand the position that you're in currently at the moment as well, and ensure that you can hold on to the property and there's a bit of a buffer. And yeah, people should continue with the current state in mind. But at the same time, people like Westpac economists and Treasury modeling have come out and said, like, property prices might dip initially, but then they're still going to grow after a settlement period. There's going to be a little bit of a settlement period. People will get used to it, and then they'll still continue to grow. And I'm buying in regional locations at the moment where they're still moving as well. So it's really just down to affordability and economic forecast. And
yeah, I think it's reasonable to assume, short-term pain, long-term gain. I think comes easy. But if you're willing to take a little bit of risk, I guess, but that's what investing is. You have to put some risk in. It's not all fun and games. But if you can dip in when others are a bit hesitant, it could be a really good time. And by the time you've seen it on the news that it's back up and running,
it's already too late.
Right? It's already gone up 5%. You think you're getting a discount, it's back to square one. So yeah, I just like to look at it from a logical and reasonable point of view. Look back at what's happened in the past. I know it's not a real indication of what could happen, but just use your judgment and say, hey, property prices are going up. If I intend to hold this long term, if it's a good asset with the fundamentals of growth, then it should still continue to go forward. And I still got to invest. I can't not do anything with my money. I can't just leave it sitting there. So what other choices do I have?
Yeah. It's one of many investment vehicles, one of many asset classes. And at the end of the day, all investments carry a risk. So you just need to be aware of that at the end of the day. Maybe adversely, how do you find owner-occupiers are seeing it? There's a lot of talk about auction clearance rates, predominantly in Sydney and Melbourne, less competition. Are owner-occupiers or potential owner-occupiers, first-time buyers, are they jumping for joy? Or
some of them are. I've had some pretty good owner-occupied purchases over the last, say, 3 to 4 weeks. People that were looking maybe for a few months, and now they've managed to secure a property at a fair price. It's not a bargain, but it's a fair price with less competition. Properties were going to auction before, maybe they've passed in, or the agents and the vendors' expectations are still from 6 months ago, and they've been able to say, well, hold on, the market's the market. If you need to sell, this is what the price that we're paying today. So I think for them, it's been quite good. First home buyers are still, I guess it's a bit trickier for them. They're still limited, and supply is kind of a little bit funny at the moment. But people that have deposit, people that are maybe upgrading as well, where if they're, buying a $2 million place, if they have a $2 million place and they're buying a $4 million place, they might see a 5 or 10% drop, but they're upgrading. So in a lot of cases, there's a bit of risk, but they're saving money. It's been great for them, great for me, for owner-occupiers on the whole, especially compared to investors.
Yeah. I think at the end of the day as well, prices in those two locations, Sydney and Melbourne predominantly, they'll fall to a level at which demand meets them. So at the moment, there's less demand because investors are pulling out. And typically those locations are lower rental yields. So there's less support from those negative gearing changes, or there will be less support from 1 July 2027 from negative gearing changes. So that being said, like, it'll fall to a location where demand meets it, number one. It'll also fall to a location where it makes sense in terms of a cost. Like, you can't build for any less. Like, construction costs are still a certain amount. Like, a brick still costs what a brick costs. Labor still costs what a labor costs, etc. So it won't fall to below ridiculous levels. And people that are expecting that should really have a think about that as well.
Yeah, I think it all comes to a point where if there is great value, someone's going to buy it.
Yeah.
And if someone out there, they might be the investor, they might say, I've never seen these prices this cheap, or I haven't seen an 8% drop in so long. I'm going to jump in.
Yeah.
It might hurt me for a year or two, but I know in the long run, I'm buying at a discount.
Yeah.
So that's going to happen eventually. I think if people are thinking drop prices are going, all this crash has been going on for years since I was born. So if people think it's going to drop 30%, they have another thing coming. Yeah, 5 to 10%, I think is possible. But as soon as, like you said, as soon as it starts to make sense, people are going to start buying again. And it doesn't matter who it is, those prices will start to correct. And then, in another 2 or 3 years, we'll probably be here saying, hey, you remember that little blip in the system where it went down 5%? Well, hey, now we're up 15%.
Yeah. And I think the truth about the bottom is you don't know until it bounces. So we mentioned previously, like by the time you hear about it in the news, it's already too late. Like by the time you see the bottom, it's already too late. You've already missed the bottom. So don't wait for that bottom.
Yeah.
What about existing owner-occupier holders? We talked a little bit about upsizers and how it's a good idea to upsize in a downswinging market. Sorry, if you're sitting in a $2 million property and you're buy a $4 million property, the market moves 10%, then you're moving from 1.8 to 3.6. Now it's no longer a $2 million gap; it's a $1.8 million gap. So it makes more sense for you to upgrade in a downswinging market. Where are those owner occupiers sitting when they have those discussions with you, predominantly from a lending perspective?
In terms of borrowing capacity?
Yeah.
Look, nothing really much has changed for them. We're always going to have our quarterly updates with bank calculators and expenditure measures. So, and they're always increasing because inflation's going up over time and things just cost more. But, especially in the area that I operate in, here in Sydney, especially if you look at the inner west or really anywhere in Sydney now, there's a lot of people that are professionals and they're earning good money. And yes, they have to stretch a little bit for that. But if they can see value, they are happy to do so. And I think people are, once they've got a taste of the market, they know what they have to do to get in. Because once you're in, it's easier. But when you're out of the market for a little bit, or you haven't reached that, or you're just not in yet, it's just hard to get in. So they're sitting okay. I think owner occupiers are fine at the moment, especially if people want to buy. One thing that the budget has allowed them is they can buy a place to live in. If they convert that, or if they bought it before budget night, right? If they convert that to an investment in the future, that could still be negatively geared. So people aren't as concerned. Of course, they have some reservations about the market and they don't want to overpay. That's always going to be the case. But they're making jumps because they're saying, well, hold on, negative gearing is still there for owner occupiers. If I bought it, however many weeks ago before budget night, and I convert that, well, I can still have that negative gearing. So, what I was going to do, my plan hasn't really changed. If anything, it's just made me realize that, okay, I do need to get in while the time's right before another change in 6 or 12 months. And we're back to square one at prices. You can't pick the bottom. Like you said, I've found over the years that the bottom is usually, before you get to the bottom is the bottom. Because then it reaches a point where it becomes so affordable and so much of a discount that it starts to swing back up already. So, yeah, owner occupiers are sitting pretty, some people, but, these changes, they're not really helping first home buyers. Let's put it that way. I don't feel it. There's a little bit less competition, but that's not helping everyone. It's only certain clients, certain segments of the market.
Yeah, I feel CGT changes have impacted supply, or they will impact supply, because if we use that scenario that we talked about where we want to upgrade in a downswinging market, you're going to be a little bit more reluctant to sell your property now because, number one, it's grandfathered. Number two, you might not want to sell it because because you have that grandfathering and there's less competition. You might not get the price you want for it. So a lot of people are going to be thinking, well, I can upgrade, or I can afford to upgrade. I get a good price, but then I get these grandfathered negative gearing changes. Number one. Number two, I'm going to have to potentially pay CGT down the track, and I'll only exit if I get the right amount of money for it. So there's going to be a big decision as to whether or not to sell. And a lot of existing investors and owner occupiers will be faced with that decision. Like, do I sell now in this market, or do I hold on to it until I'm happy with the result?
Yeah, I guess the thing that I've got to look at is I can't just talk about my clients, right? Because my clients are only a small segment of the market.
Yeah.
And I'm lucky that they've been successful over the last, 4 to 6 weeks since the changes. But when we look at the whole segment, the whole, Australia
Mm.
as a whole, there probably will be a lack of supply. If I had a place that's going to be, CGT will change come 1st of July next year, I got to get a valuation, then it's going to start being, calculated differently with indexation. If I don't need to sell, I probably won't.
Mm.
Why would I? There are some people that it is helping, a very small amount, and that's usually the ones that have had, a low amount of capital growth.
Mm.
They could potentially be slightly better off on that model. But anyone that's had good growth or anyone that's got a previous property that's grown, well already, yeah, why would they be paying extra tax? Could be hundreds of thousands of dollars in some cases if they don't need to,
Mm.
right? Previously, I had people that would get a good price and they go, yeah, it's a top price. I've doubled my money. I'm going to sell. And, going forward, they might not see that. They might say, well, do I need the money? No. Can I still borrow? Yeah. Well, bad luck. I'm going to hold on to it.
Mm.
And that's where we see that people trying to get into the market, if they haven't got a strong deposit, if they haven't got choice in the area that they're looking, they're probably going to suffer just because of lack of supply. And that could have a whole range of effects. It's hard to predict, but that's the one thing I guess I have to stand back and say, all right, yeah, I've had some, it's only been 4 to 6 weeks and it's been great for people that have already been looking.
Yeah.
What about those that weren't looking before this date? Is it harder for them? Are there properties on the market that they like? Because I've got others that have been looking for a while and they just go, Andrew, there's nothing.
Yeah.
There's nothing I like. They're rubbish.
Yeah.
And the ones that I like, they're still going for good money
because
they're sought after and people are, paying a premium. So, tell you, you could talk about it all day.
Yeah. And I think that's the biggest difference between a boom and a bust market. Like we're heading towards the bust market and the good properties will still sell in a bust market, whereas the poorer properties, they'll take a lot longer to sell. But in a boom market, like virtually anything will sell because people are just that desperate. So I think vendors should be put on notice for the coming period as well. But there's been a couple of changes on the back of the budget as well. The other changes that we've noticed are around trusts. Trusts previously were fairly popular amongst investors, and we're seeing changes now to the minimum 30% taxation on the distributions from trust. What are some of the other entities that people are considering, and how should they consider their borrowing capacity in those entities?
Yeah. Look, first I'll say that nothing is confirmed yet. And I think out of all the changes that have been proposed, the changes to trust and bucket company taxes, I think they've got some room to wiggle. I'm no economist, but, you just think it's such a change. And not only is it a huge shift for everyone, but the amount of work that's going to be involved for all clients, all accountants, and the ATO is just huge. So, look, people are waiting, but people that want to get on the front foot and they're happy to go forward. We do see that at the moment companies have been unaffected. There's been no sale of what happens to a standard company purchasing that. Not a bucket company, I guess, but, in that entity. So that's one thing. If you were purchasing in trust before, you might want to hold off a little bit if your accountant says so. I guess the major thing is get the advice. It's quite technical. You can't just listen to social media. You can't listen to people that have done it before. You've really got to listen to professionals, and the only people that are in a great places to give that information at the moment, financial planners and accountants, probably the two best. And even they're having a hard time to really get through everything. So, company structure, potentially one to look out for. Yes, that could be a way forward for the advanced investor in the next couple of years. And we've seen that SMSF has been unaffected from the budget. So people trying to buy in a self-managed super, that might be a great option.
Yeah.
And, that's always been an option for people. But if you're on the fence as to what entity to buy in, you might think, well, okay, super seems like it's a good thing at the moment. As long as I've got a strong balance, what are the pros? Let me find out more about that. And that's what it is. I guess it's just not making any rash decisions. It's getting the information, weighing it up, speaking to your team around you, mortgage broker, accountant, buyer's agent, financial planner, whoever's on your side, solicitor, and trying to make the best decision for the long term. As long as they're long-term decisions, that's the main thing. But and I'm sure we've seen already on social media, everyone go buy in a company. By SMSF, yes.
I've seen so many whiteboard bucket strategies. I'm like, copy my company strategy, convert to A, B, C shares. And I'm like, please, man, don't do that to yourself.
Just, if anyone's listening out there, please, and you're thinking of this, just take it easy, get the proper advice, work through the numbers, and don't just rush off someone that's, to be fair, that's not trained or not a professional in that field. Just because they said it doesn't mean it. If I tell you the amount of messages on social media I get, hey, should I do this? Hey, is this still good? I'm like, yeah, for a certain segment of the market, for a certain client.
Yeah.
It probably doesn't apply for 98% of people.
Yeah. I wonder if ASIC and APRA are on social media, because they'd have a field day, I reckon.
They are. After when Macquarie shut down trust lending and everyone's followed, I think social media's had a lot to do with it.
Yeah.
People putting information out there that, whether it's right or not isn't the thing. It's, are they trained to do this? Do they have the license to be saying that? And are they putting the right disclaimers out there for people? So, yeah. But I guess for the advanced investor, the one that's already got a portfolio or has the information, the right information, the right team around them, yeah, there are some things to look at. You might want to be looking potentially more at a company structure if it fits your strategy. Self-managed super could be a way to go forward if it was already on the list for you. I wouldn't just be changing my strategy just because of that.
Yeah.
But if it was there in the first place, it might have just crept up the ladder a few places. Yeah, for sure.
It might be a little bit more applicable to you now, given the circumstances.
Definitely.
Yeah. I'd imagine now, especially with the investor market, those existing investors would be looking at potentially refinancing, because they're likely to want to keep the debt high now that they've got the grandfathered product. Are you seeing a lot of refinances lately?
Yes, I am. I think the two, over the last, say, probably 6 weeks, and it's only been a short time, but where I see a lot of change is, okay, yes, investor purchases have slowed.
Yep.
Okay. But there's been a lot of slack that's picked up from the owner occupied and the refinance segment. And where that comes into it is a few things. So investors, number one, wanting to keep, their debt high, because as we know, once you've got a debt on your investment, you can't really increase it.
Yeah.
Okay. There's some, a few circumstances, but generally speaking, no. So some people are moving forward to restructure and refinance for a few reasons. Number one, while valuations are still quite high, okay, bank valuations, online valuations, whatever you want to call it, sometimes there's a slight lag. So I'm getting some great valuations to some customers now, but we don't know what's going to happen in 3 or 6 months. If your place is worth 1.8 on paper now, if it's worth 1.8 on paper now, then who knows, it could have a 5 or 10% drop. And then all of a sudden, what you want to do is not applicable anymore. And the other thing would be, people keeping the debt high, resetting back to 30 years, renewing their interest only period back to 5 years, or potentially even higher. We can go to 10 or 15 at the moment, which some people are looking at doing, and that would keep the debt high, keep the negative gearing benefit as high as possible until we know what's going to happen. So I am doing a lot of them, and it makes sense as long as there's some kind of benefit to your strategy, whether it's loan term, interest only, then absolutely. And I think the savvy investors and the good mortgage brokers out there, are liaising with each other and saying, hey, we need to make a move potentially if you want to do anything. And these are the reasons why. Why not? What do you think?
Yeah. I'm curious around if investors can potentially refinance and tap into additional equity, but make improvements to the property to improve the capital value and rental value from the property. There'd probably be an interesting question from an accountant rather, to ensure that that tax deductibility, that negative gearing is still applicable. But that could potentially be an option for existing investors if they are have existing investment property and they're looking to tap into equity and they're looking at doing something with it while retaining the negative gearing benefits.
Yeah, absolutely right. It's got to be structured correctly and get the right information up front. But if there's a chance, you might want to do some renovation, some maintenance, some repair, right? There are strict rules around the ATO's guideline for that. But if you're doing some kind of work, whether it's you can deduct it straight away on your tax, whether it's depreciated over a period of time, there is usually some benefit. And if you have untapped equity there and you think you might need to do something in the next couple of years, then there's no harm in getting the money up front while you can. We do find people think about it only at the last minute when they need it. Lo and behold, policies change. Lo and behold, calculators change. And then, we're struggling to find the bank that will make it work, but it wasn't our first choice 6 months ago. So being on the front foot's important. I like to make sure with my clients that if not every 6 months, every 12 months, we're having a conversation. Hey, what's your property worth? Have your circumstances changed? Do we need to do any major structural changes rather than just a rate check?
Yeah.
Do we need to do anything? And it's never too early to have that conversation, but it can be too late.
Yeah, exactly. Yeah, it's always a good idea to do a cash flow analysis as well. I think, and just maybe sometimes tap into that equity just to have that cash flow buffer as well. Just to have like 10, 20 grand to sit in there to take those, additional supplement the difference between the what your income and what your expenses are. So that's always a potential for existing investors as well.
Always. If you want to make moves, if you want to invest, if you want to just, especially in today, cost of living is a big talking point.
Yeah.
You got to have those buffers, whether they're your cash buffers, whether it's in, just a line of equity just sitting there as an emergency. We've got to have that. And if you haven't got 6 months worth of repayments and expenses on the side, you're really, I guess, not putting yourself in the best position possible. So if you have the ability to do so, yes, do it. If there's equity, you don't need to use it. We can do an interest-only loan for 5 years, as long as your borrowing capacity permits, and it can sit there.
Yeah.
If an opportunity comes along in a couple of years' time, the money's there ready to go.
Yeah, nice. Yeah. It's probably important to note as well, everybody that is watching and listening, that anything that we talk about is only factual in nature. It's only general in nature, sprinkled with a little bit of factual information from whatever's happening in the market at the moment and the budget in particular. But we've mentioned a couple of times now, it's still not legislated. It's likely to be legislated as of 2nd of July. But I really wanted to thank you for your time, Andrew. Thanks for coming on.
My pleasure.
If anybody wants to get in touch with you to discuss further, how's the best way to do so?
Yeah, a few ways. You can jump online and you can just Google me, Little Bull Finance.
Yep.
All right, you will see that there. And we've also got my social media, Andrew.yourlocalbroker, or my phone if you really do phone.
Yeah, we could do phone.
Phone call 0404 548 568. But hit me up on either way, Facebook, Instagram, website. The major thing is just if you got any questions, just reach out.
Yeah, for sure.
That's all.
Thank you so much, mate. Really appreciate it.
Thank you.